an important idea which we use whenever we are working with options, because we know that option for any option, volatility happens to be an important parameter, and that is something which is frequently used. So, firstly, understanding the meaning of volatility. Now, this is defined as, so when you say volatility, what comes to your mind? What could it mean?
Mathematically, it could mean deviation.
Okay, correct. Correct. So if you see the normal Gaussian distribution which you used to see, so anything which moves away from the expected value, let's say this is my expected value, then any deviation away from this is what we call as a risk or a standard deviation. So many a times we also call it in terms of volatility, that is away from expectations. How much do you expect the movement on that on either sides? So again, volatility happens to be a measure of risk which we use in a certain product or a certain portfolio. So now we know the basic idea behind volatility. So any guesses as to why this analysis is important? Now, why do banks require it for trading and risk management? Any activities which you can feel are dependent on this analysis of volatility?
Sir, it could be to make sure that they aren't holding toxic assets.
Okay, so asset quality.
So, like best example would be like the scenario happened in margin call. So they discover it at night that what has happened, and they have broken through the volatility.
Okay. Anything else as to why we may have to actually bother about volatility? Okay, so I have a few points here.
So your capital provisioning requirements would require you to know the volatility, right?
Yes, correct. Yeah. So yes, I mean correct. So that point is mentioned here as well. So we can talk about these. So correct. So firstly, I mean we could start with the straightforward bit, the pricing bit, because for pricing your option portfolio, we would require a volatility number. So naturally, that happens to be one important input in the option pricing model. Then for value at risk as well, we would require vols, because again, we have a large portfolio of, let's say, options or option linked products. If we are to calculate what is the risk of that product using our VAR technique, then we would require some additional and this additional step, because without that we will not be able to figure out what the VAR for that options position is. Then even capital charge. So even the regulatory capital charge, as we call it, the Basel III capital charge. So there, if you see, we have a gamma and a vega charge, which gets used, and that is linked on the kind of volatilities which we are using. So those two charges, and anyways, pricing bit always flows into the capital charge calculation. So that is where volatility is going to impact again. And even for CVA, because CVA we had briefly discussed in one of our previous sessions, is what we call as a credit value adjustment. So mainly an idea covering the credit transition risk for any portfolio. So again, for the CVA bit, we mainly calculate our exposures, and exposures are then adjusted for collaterals, and they are risk weighted based on the credit ratings, etc. So again, there also you have all of your derivative positions which are sitting on the books. So again, options happens to be one of the products. So that gets, so again, volatility plays an important role in CVA calculations as well. Also, there is a CSA agreement. So have we spoken about credit support annex? Because this is a part of credit risk management for a bank. So have we spoken about CSA earlier? Or maybe have you heard about CSA earlier? We have, is it? Okay. But if not, I mean, generally giving an idea, because again, CSA is dependent on your portfolio valuation. And what is CSA? Now, CSA is an idea whereby banks try to mitigate their credit risk towards each other. So let's say I am a bank. Let's say I am Bank A, and I have a frequent trading relationship with three banks, X, Y, and Z. So let's say we are transacting almost every day or at regular time intervals, and we have a large portfolio which we are holding. That is, we are counterparties to that portfolio. So again, whenever I have derivative transactions which I do with multiple banks, I am naturally exposed to a counterparty credit risk there. Now, why I say that? Because the derivative can be on for a very long period of time. So imagine that I have, let's say, swaps, options, forwards, etc., with counterparty X. So let's focus on just X for the moment, because once we understand this method, then applying it for Y and Z is easy. So let's see what happens at X. So let's say I have about 200 transactions which I hold with counterparty X and a variety of transactions. Now, I know that there is a credit risk involved because these transactions are bilaterally cleared and settled. It's bilateral because me and party X are managing the credit risk ourselves. Imagine there is no CCP here, or we can't really use the services of CCP because maybe my product is customized. So let's say that could be a reason. So in that case, in order to minimize my counterparty credit risk, what me and counterparty X do is we do the portfolio valuation on a daily basis. So every day at the end of day, my back office will come up with a valuation of the portfolio. Let's call it as V1. And let's say portfolio, or let's say bank X back office also comes up with the valuation, like they call it as V1 star. Now, these two numbers are going to be very close to each other because we are valuing the same portfolio. Only thing is our inputs may be slightly different, and the methodologies or assumptions which we use for valuing our portfolios could be slightly different. I don't expect a very large variation in V1 and V1 star because and the approaches used are mostly consistent, maybe a few changes here and there. So V1 and V1 star will be close to each other, but one of them will be greater than the other. So let's say V1 is greater than V1 star. That is, I am holding a net positive MTM as compared to counterparty X. So that means I have a positive exposure to counterparty X. Now, that means tomorrow or overnight, if counterparty X defaults, then I am standing to lose a certain sum of money. So in order to address that risk of overnight defaulting, we have this CSA agreement which has been designed. And CSA agreement says that you calculate your portfolio valuation on a daily basis. So I have come up with V1 and V1 star. And after that, do a comparison. Now, whichever bank is in the money, the other bank is supposed to make a payment to the other bank. So that is what you call as a collateral exchange. So collateral exchange happens on a day-to-day basis. Now, earlier, CSAs used to be exchanged weekly. But now banks have become more credit sensitive. So they know that counterparty credit risk can crop up at any point in time. So in order to mitigate that, they keep on exchanging collateral every day. So you have a CSA exchange which happens daily. And most of the times the CSA exchange is an exchange of cash collateral. So actual cash gets transacted between two banks so that their collateral positions are managed. And that way, my counterparty credit risk gets mitigated. So is this idea okay? Any questions?
So is this like kind of mark-to-market mechanism, like some sort of?
Yes. So V1 and V1 star is nothing but MTMing my portfolio. So both of these are MTMs. So what is the value standing today? So the idea is that valuation is going to also reflect the kind of credit risk which I am exposed to. And through that, we try to decide on the value of collateral to be exchanged. So if any of you happens to join a bank, then you will get to see these CSA agreements. So it's a proper legal agreement between two counterparties. And they say that this is the frequency of the collateral. Also, they decide on a certain quantum of how much should be the minimum amount which is to be transferred. Because that's mainly from streamlining your things operationally. Because let's say difference between V1 and V1 star is just $100. Then in that scenario, honestly, it doesn't make any sense to exchange collateral, right? Because $100 is a very, very small sum of money. So, and let's say V1 versus V1 star, this difference is maybe, let's say, 50,000 US dollars. Then this is a comparatively larger difference. Now, what a bank could do is a bank could set a cutoff. Now, this will be like a mutually agreed cutoff. So they will set a cutoff such that if the difference between V1 and V1 star is greater than, let's say, $10,000, then we are going to exchange collateral. If it is below 10,000, we are not going to exchange collateral because operationally they are trying to make things simpler. Now, if it's a very small quantum, now honestly, $100 difference is nothing, right? I mean, a bank can easily bear this much of a loss. But if it's maybe something as high as 50,000, banks may say that no. I mean, let's define a threshold. And to keep things easy operationally, the moment this difference, V1 and V1 star, breaches 10,000, we are going to exchange collateral. If it stays below 10,000, we can simply ignore that. So that is just to make things easy from their operational or operations perspective. But again, for CSA, since we are doing MTME, we are going to require volatility. So generally, whenever you study ISDA, along with ISDA, CSA also happens to be something which gets mentioned there. So those of you who are taking FRM exams will anyways be studying CSA because that is a part of the FRM curriculum. But otherwise as well, you'll get a lot of content on CSA, something which you can definitely check out. And if you happen to join risk management within a bank, you will also get a hang of exactly how the CSA transactions happen. So that is something which I request you guys to generally have a look so that once you join the industry, you'll already know these things. That overview of options portfolio for banks. Now, if I talk from a domestic perspective, most of the banks in India are going to have FX options. So when I say options portfolio, generally it's synonymous to FX options for Indian banks at least. And most of the times, the most popular currency is USD INR. There could be, so volume wise, this is the largest. So the liquidity which is offered by USD INR pair is very, very good. There are other pairs as well. So there could be a fewer number of Euro INR trades or maybe even GBP INR trades. These are comparatively fewer in number. USD dominates the market. So USD INR is by far the most liquid FX option which you will find on a domestic bank's portfolio. Now, you will hardly find any equity options. I honestly have not seen equity options on banks' books. But if there are, the number will be very, very small. And again, interest rate options, yes, to a certain extent. So banks use caps, floors, collars, swaptions up to some extent. Again, the volume is comparatively lower. So generally, when you say options, it's synonymous to FX options. And again, when you say FX options, there is a standard guideline which comes through Basel. So we have a point on capital charge here. So the how to calculate the capital charge, etc., is clearly defined as a part of the Basel III circular. For global banks, the portfolio could be larger because in India, we do not have a very liquid market for structured options. But globally, yes, that is always a possibility because if you compare markets in Europe or North America, these are developed markets. So you have a lot of sophisticated products which transact there. So maybe in addition to vanilla products, they'll also have exotic varieties which get transacted. So if any of you happens to join a global bank at a later point in time, you'll get to see other option varieties. If you stick to the Indian markets, then it will be mainly vanilla options and a very few structured varieties, mainly interstate options and exotics, not really. But maybe RBI may open things up because at the moment RBI is allowing only a few exotics to be transacted. So barrier options is something which the RBI has given its green light to, but other options not yet. But I think RBI is also gauging the market demand, and based on the market demand and its own risk tolerance, RBI could take a call on revising the circular around exotic options. And maybe in a few years' time, we would have more amount of exotic varieties because post 2008, RBI had put a complete ban on exotic options. But recently, if you see a circular which had come in a few months back, RBI has given a green light and some first level exotic options can be transacted now. Now, types of volatility. So what could be different types of volatility? Any guesses? Or different ways in which you can calculate volatility, to be more precise?
So do you mean the implied volatility and the actual one and all these terms?
Something similar, yes. So implied is one approach, yes.
So one is historic volatility.
Correct.
Second is implied.
Okay.
Not sure if these are different or the same.
Yes, they are different. Yeah, we'll go through them. Anything
These are the
else?
only two I know about, sir.
Okay. Anything else which anyone has in mind? Maybe a third variety. So I'll give you a hint. It is based on the idea of something which you use for company valuation. Some idea which you use in company valuation approach. So you have a DCF, you have a dividend discount model, and you have something else in company valuation. So something similar gets used here.
Cash flow or the discounting factor, which could
Not really. Something to do with that premise of using something else to value something, or something else to value an option, or maybe value a stock.
Peer analysis, sir.
Actually, very good. Thank you. So, peers or comparative what? Correct. Yeah. So good. So the first three ones. So we'll discuss the first three ones. The last one is slightly complex. We'll just touch upon this. We'll not get into too much of stochastic volatility because we are learning walls for the first time. So I would say that, so as you guys have rightly said, the first three options have been listed here as well. So when you say historical volatility, this is based on the prices which are there historically. So imagine that I have a certain stock X which I'm looking at, and let's say that X is a very liquid market and it is transacting almost every day. So I have a new closing price which is available, and stock X has been transacting for a long time. So that way it has a very long history. So what I can do is I can look at the day over day returns in X, and then I can calculate volatility. So I simply calculate the standard deviation and I take a scale of standard deviation. So always remember, when you're calculating such volatilities, it should always be the returns volatility. It should not be the price volatility, because finally, from a finance viewpoint, you're always interested in what is the return on a certain asset, not really the price level. So price level, yes, but finally price level gets translated into a kind of return which one is earning. So always remember, whenever you're calculating such day over day changes, or make sure that you calculate day over day changes and then calculate volatility. So I could have historical numbers of, let's say, the last 500 days. So I take these closing prices, I simply calculate the day over day returns, and then I simply apply the standard deviation. And when I square the standard deviation, I get a volatility number. So something simply which you can do in Excel, and I'm sure you must have done this in Excel as well. Then is, so comparative we'll see in a bit. Implied volatility is something which is very, very popular. Now, can you guess that why implied volatility is a preferred approach over historical? So why do I want this if it's available rather than historical? So what's so special about implied volatility?
So it tells us how the market is also expecting the price to change.
Correct,
So
correct,
and people will be buying and selling according to that. I
correct,
guess that is a more it's a bigger deciding factor than historical volatility.
correct. Good. Yes. So the idea is implied volatility comes from your traded options data. And your traded options data is a reflection of what is actually happening in the market and also what is the perception of investors. So by looking at implied volatility, we get a more realistic picture. So when you're pricing options, your implied volatility is always the preferred measure. But unfortunately, implied vol may not be available all the time. So when that is not available, you may have to resort to probably historical volatility. But otherwise, implied vol is the preferred one. Now, why the name implied? Because that is something which we try to imply from the option price data. So let's say I have this equation or maybe this function for options. So we have value of an option which will be dependent on the stock price, strike price, time to expiry, interest rates, and volatility. So these are the 5 variables which we require for pricing any vanilla option. So let's say V is my option price and I have some function of these variables. Now imagine that this is a traded option. So I have the value of V uh, which is available. I can simply fetch that from what the market is quoting. I know the spot price. The strike price is already known. It's a part of my term sheet. time to maturity, it's easy. I can measure how much is my time to maturity standing today. R is available because I can simply open a Bloomberg or Reuters and I can get to see what is the risk-free rate. And this is something which so the last term is something which I'm trying to compute. Now, this is something which is not readily visible. So that's why we call the name as implied volatility. That is based on all of this information, all of the remaining variables information, we are trying to imply sigma. And that's why the name is implied volatility. So we can imagine this is also like a forward-looking volatility because the market is trying to estimate how exactly the options market would behave going in the future. Again, it's a very, very fluctuating measure at times depending on what type of market we are on at that point in time. But that's why the name implied. Then you have a comparative analysis of peers. Now, can you think of a scenario where comparative analysis may be required? Now, this is generally not a preferred approach, but there can be scenarios where you're forced to use this. So can you think of a place where comparative peers would be required or comparative analysis might be required?
Sir, suppose in case of commodities, so if you want to trade on a commodity that is not listed on the exchange, because my understanding is there's only a limited set of commodities that are actually traded, right?
Mhm.
If you want to enter into a contract in something that is not liquid enough, you can compare it to other similar products. Same goes with FX also.
Correct, correct. Good. So yes, absolutely. I mean, a good example. So something which I have done in the past also, I can give you an idea. So actually, we were doing a fair valuation exercise. So this was during my time in Deloitte. So we were doing a fair valuation exercise for one of our clients. So we were appointed as third-party valuation agents, and we were expected to calculate the value for their convertible bond. Now, a convertible bond, as we know, has a conversion option. So there is a bond plus there is an option. So the bond portion is comparatively straightforward to measure. I mean, here you simply take your risk-free rate, you adjust it for credit spread, also a country risk spread, and then basically you price this bond. So again, when you're pricing foreign or something like a FCCB or FCCN, always ensure that you're taking into consideration country risk premium as well. So otherwise, generally, whenever you are pricing a bond, so just focus on the bond portion for the moment. So for a bond, we generally have the risk-free rate plus the spread, which we use as a measure. But when you're pricing a foreign bond or something like a foreign currency convertible bond, which you're invested in, you'll also need to adjust for a current country risk premium. So one way to figure out what your country risk premium is, you could look at what your current country rating is. Now, if your country has an active CDS market, then yes, you can directly fetch what the spread can be. Now, what is the CDS spread, etc., we'll see in the latter part of today's class. But imagine that my country has a very active CDS market, so I can look up the CDS spreads for that required tenor, and I can use that as a proxy for country risk. If not, I can use it for a relative country, which I use, and then I look up the country risk. But I mean, let's not worry about the country risk much right now. But this options part is something which I would like to talk about more because this is where I had to use a comparative analysis. So the bond portion is easy. This was taken care of. But for options, the thing was the company for which we were doing this option pricing, or maybe I would say an embedded option pricing, they did not have a very active options market. That is, their company stock did not have a very active option which was transacting, or even if there was, it was a very, very illiquid market. So, and using that volatility or using that as an implied volatility would have been an incorrect measure. So at that time, what we did was we did a comparative analysis. So how do you do a comparative analysis is you try to find out peers which are there in a similar line of business as yours. So now, before we go into peers, I'm saying similar line of business. So, so any guesses why I say similar line of business? Why not something else? So I'm trying to find out peers who are in a similar line of business as mine. So what is the significance of having someone who is there in the similar line of business as me?
They would face the same market forces and the same regulations, kind of.
Correct.
That could
Correct.
be a reason.
Yes. So someone who is there in a similar line of business like me will face similar kind of risks. So also, when you say you're picking up peers, always try to use single or standalone companies. Avoid using a conglomerate, because if you try to use a conglomerate, what happens is their risk can get diversified. So you may not get a true picture of risk. So imagine that I'm doing some kind of a peer analysis and I decide to use Tata Group or maybe the Reliance Group as a proxy. Now, that will not be a very correct measure of doing things, because if you see the Tata Group or Reliance Group, they have a variety of businesses which they are invested in. So, using them as a comparative company might not be the right idea. But if I can pick up a certain company which is in that specific line of business without any other lines impacting that business, that could be a better measure. So always remember, whenever you're doing comparative analysis, try to pick up a standalone company which is specific to a certain industry rather than a conglomerate, because conglomerate risks are different as compared to individual company risks. So that was the first thing which we checked. We picked up a few peers which were very, very close to us. So let's say I'm doing the analysis for a company X and I found out three peers, A, B, and C. So these are my peers. And this is my company in question, or this is my subject company. Now, my subject company, as I mentioned, does not have an active or does not have a very liquid traded data which is available. So I'm dependent on my peers. Now, peers A, B, and C had a very, very active market. So that way it was very easy for me to get options which are transacting on A, B, and C. But now, how do I choose that? Which wall number do I need to use? Because I have options which are liquid for all three, A, B, and C. But given this information, how do I pick one over the other? How do I decide whether I need to use the volatility for A or for B or for C? So what could be a way to figure out? So how do I choose between the three? Yeah, any approaches which you can think? So I need to figure out which volatility do I choose? Volatility for options A, volatility for options of B, or volatility for options of C? So can I do some kind of a correlation analysis? So can I plot a correlation matrix? So a correlation matrix is nothing but a simple 2 by 2 matrix, which will help me figure out what the correlation is. So it could be something like this. So let's say I have X, A, B, and C, and again, A, B, and C. I need one more X here. But the thing is, I can simply plot the correlation matrix based on, let's say, the historical stock data which is available, and I can do an analysis because I have a stock data which is available for X, but I don't really have a very liquid options data. That is fine. For correlation, I simply need to know my closeness to each of the or either of these counterparties, and whichever parties for which I have the highest correlation, I can pick that, and I can say that that is the peer which is closest to me, and I can use that, or I can use that peer's volatility as a proxy for my analysis. So let's say based on my correlation analysis, I come up with the result that party A is the one which I'm closest to. So I can simply look up the options data or options walls data which is available for party A, and I can use that to plug in the wall number in my model for pricing the option for party X, which is my subject company. So this is how you can use peer analysis. Now, generally, not a very preferred approach, but when you're left with no other choice, you may have to use a peer analysis. So if you do use such kind of analysis, always ensure that as a part of your report, you have to clearly mention that what exactly you have done. Because otherwise, if you say we have just used volatility, people may feel that you're talking of implied volatility, which may not be the case. So if you're doing some kind of analysis, you may have to give some additional sections giving why you have done that analysis and how you have done that analysis. So the idea is try to make your reports as comprehensive as possible so that whoever is reading that report later, they should have all of their queries resolved within the report. So questions should not come back to you. So these are generally the three popular techniques of walls, but given a choice, if I have to put priorities, use implied walls. If not, use historical walls. If not, do a peer analysis. But whichever you use, always try to have a section explaining what you have used, so that way anyone consuming the report will not have any confusions in their mind. Stochastic volatility, a slightly advanced approach. Now, this is something which you require for exotic options. Now, if you're working as a part of the domestic bank, you'll not really require too much of stochastic vol analysis, because unless you are specifically working on exotic options, and you don't really require stochastic vol as a measure. Now, there are certain ways in order to avoid stochastic vol as well. So, options up to a certain degree can be handled using basic analysis. You don't have to do the stochastic vol modeling, because this is difficult, or stochastic vol modeling is time consuming. There are a quicker approaches to handle certain first order exotics. So we'll talk about that. So maybe once we talk about wall smiles, I can give you an idea of how exactly you can adjust a wall smile in order to apply it for something like a barrier option. So something which we call as a Vanna and a Volga model. So we'll talk about that in a moment. But any questions on this slide for anyone? Okay. So a few things we have discussed earlier, but we can quickly run through. So implied vol is something which is used in every option pricing model. So we have discussed binomials, Black-Scholes pattern, and Black. So I've just made a mention of these three. So in each of these models, if you see, you have a sigma term which comes in. So sigma is the volatility bit which we'll have to use in our calculation. Now, without vols, you can't really price that option. Now, this adjustment of Vanna Volga is something which we are going to do, because for that we need to understand what the vol smile is, and there are certain drawbacks to the Black-Scholes. So we'll talk a bit about those I won't say exactly drawbacks, but a certain shortcomings. So there are certain shortcomings which we try to overcome. So how those are overcome and why Black-Scholes framework is still relevant, that is something which we'll talk about in a moment. Then flat walls versus spot walls we have covered as a part of IRO. Then there are various models which you can use for volatility analysis as well. So there is something which we call as an exponentially weighted moving average, or a Garch model as well. So these are also popular models which one uses for volatility modeling. So again, for fitting these kind of models, especially things like Garch, you require some kind of a tool. So you can either do it in Excel, but with Excel it can be slightly painful. But with numerical or maybe scripting techniques like Python or R, doing Garch modeling would be comparatively easy. So since we are on the idea of Garch, now let's say I want to fit a Garch model. Now we don't have to get into the specifics of Garch, but I just want to know the approach which I have to use. So let's say I have a V on the left hand side and I have some equation. So let's say I have AX plus, let's say BY plus C, something like this. So I'm just keeping it generic. Now, if I have to fit a certain equation, or let's say in the technical term which we say that we are trying to fit the model to the data, what exactly am I doing? So imagine that I have some data which is given to me. Imagine this data is in the form of a scatter plot. Now, you guys have studied business analytics. So I'm sure you must have studied something on fitting of model to data. So when you say you have fit a certain model to data, what exactly have you done? So maybe let's say this is my model, and I say that I have fit this model to this data. So this data is also given to me. So what is the idea of model fitting? What do I do that?
So we're trying to find the line of best fit, and the line of best fit is defined by how we define our errors, and how we define our errors has to be minimized as a sum.
Okay,
So
correct.
yeah, so we can go with minimizing sum of square of errors. We can go with minimizing modulus of errors. We can go with minimizing power 4 of errors. So as long as we define our error, we have to minimize its sum or some kind of function of it.
Okay, okay. But finally, what is the end result? I mean, when you say you have fit the model to the data and you have a certain result, what is that your uh,
So once you make a model, it is your belief according to your assumptions that you have a line or a curve of best fit,
Okay.
and that curve is able to explain in the best terms what the result will be given certain inputs.
Correct. Correct. Good. So yes, absolutely right. So when you say you're trying to fit the model to the data, what you're trying to do is, so in the response you're looking at, you're trying to optimize the best fit values for your coefficients. So you have A, B, and C, which are the coefficients in this case. So when I'm fitting the model to the data, I'm trying to figure out what should be the best fit values for A, B, and C in order for my model to understand the data correctly. And as Neeraj already said, there are a couple of ways to do that. So one is the OLS, or ordinary least squares technique, or the line of best fit, as we call it. Now, now how to do that line of best fit? Now there can be multiple. So imagine that I am working on a linear system right now. So if you see, I have not increased the powers of x and y, or maybe I can also change this to x for simplicity. Let's keep it as a univariate thing. So I could have different lines which pass through these, right? So I could have this, or maybe I could have this dotted line or this dotted line, etc. But we have one specific line which we call as the line of best fit. So how do I figure out which is the line of best fit? Now, what could be a measure for that? So how do I decide that this full line which I've shown is the line of best fit and not these? So there was something on squaring which Neeraj rightly said. So I request Neil to hold on for a moment. But for others, how would I decide that which is my line of best fit? Because I can have n number of lines which I can draw through the scatter plot. But how do I decide which one to choose?
Sir, which one has the least residual sum of square, RSS?
Okay. And why would I worry about squares? Can't I take simple differences? Wouldn't that make my life easy?
Sir, on an average, the sum of square is zero. Oh, sorry, the sum is zero, not the square.
Okay,
Sum of
okay,
error is zero.
okay. Okay. So a simpler way to put that is why we do squaring. Because let's say, so let me just quickly draw a simpler plot here. Now let's say these are the 2 points which I'm looking at. Let's say point X and point Y. And what I try to do is when I'm trying to calculate a line of best fit, I'm trying to calculate these distances D1 and D2. Now you see that that X and Y are on the opposite sides of this line. So that way, let's say D1 is equal to 3 and let's say D2 is equal to -3. Now, if I use simple differencing, no squaring, then that means I am getting a compensating error because then I have 3 and -3 which will cancel out each other. That way my model is going to get confused because my model will feel that X and Y are exactly the same. They are not divergent at all. But that's not the case, right? So in order to compensate for this negative signs, we always do squaring, and that's why the name is OLS, or ordinary least squares. That's why we need to do squaring, because we know that once we square something, the negative term is already taken care of. So that -3 square becomes 9 and 3 square also becomes 9. So that's why that squaring bit is important. So again, yes, OLS is one of the useful techniques which we use. So even when you're trying to figure out the best fit values for your Gauch model, you can use OLS. So good. Now this technique could be applied for a certain higher order polynomials as well. So you could use it for maybe fitting a second order equation also. So whenever you have curvatures in the equation which you're trying to figure out, maybe you would want to use a certain higher order model. But we would stick to a simpler model for now. So for this analysis, this OLS thing is decent enough. Then I would say that spend some time on scripting tools because you guys already know Python. Now, those of you who know R as well, you can generally explore that also. So the idea is scripting tools make your modeling exercise comparatively easy. Now you can do this through Excel as well. But with Excel, the thing is things can get painful at times. So not everything is easy with Excel. Excel makes you work a lot on a certain points. So in order to save on that effort, you could possibly try these scripting bits. I'll also check out if there are ready libraries around Garch. I'm not very sure at the moment because I haven't really checked the Garch model. Earlier, I had done a Garch model through pure Python. So using NumPy, Pandas, and then I'd used SciPy as well for optimizing the variables. But if there is a ready library, I'll also check out. I haven't really checked that. If that is the case, then it makes things easy for you. So something which you can definitely check out, because these are the things which you may require on your projects going ahead. So if you have such ready libraries, always try to use them because they save a lot of your time as well. Then stochastic walls, briefly we have discussed, we will not get into too much of details. Now, coming to the idea of volatility smiles or wall smiles as we call it. Now, a wall smile, you can imagine, is a simple two-dimensional plot. So you have implied volatility versus strike prices. So this is what you call as a volatility smile. And why the connotation as smile? Because if you see, this is just like a smiley which we show on a emoticon. So that's why we call this as a smile. Now, this is an ideal smile. Now, it may not be this way all the time. Now, this shape of the smile will keep on changing throughout the trading day. So many times you can have an inverted smile as well, or maybe you can have a sloping smile, something like this. But still, the name continues to be the smile because that is something which the market has been using for a very long time, and we still continue to use it as a smile. So we'll talk a bit about smiles for FX and equities. So let me just go to the next slide first, and then we'll come back because there is a chart which is there on the next slide which we'll discuss, and then we'll discuss all of these points around FX wall smile. Now, this is something which will help us relate the distribution of the product versus the smiles which have been plotted. So the top graph shows what you call as a volatility smile. So as I mentioned, this is like a two-dimensional plot of IV versus strike. And below, if you see, there are two distributions. One is a full distribution, which we call as the implied distribution. And second is the dotted one, which we have called as a log normal distribution. Now, the log normal distribution is based on the idea which we use for Black-Scholes. So if you recollect, in our Black-Scholes-Merton, we have an assumption which says that the underlying follows a log normal distribution, because we know that stock prices can never go negative, right? So we have followed that assumption, and based on that, we get a certain distribution of stock prices, which we have tried to show by this dotted line. However, we also have a liquid options market for this particular stock. And based on that options data, we get to plot this implied distribution. Now, the approach to implied distribution, again, is slightly complex, but those of you who are interested, what I would suggest is in John Hull's book on Wall Smiles chapter. So I think Wall Smile is chapter number 15 or 16. I don't recollect exactly. But inside Wall Smiles chapter, there is an appendix. So at the end of the chapter, in that appendix, you will find the way in which implied smile is constructed. So I've deliberately not included it in today's discussion because it is slightly math intensive. So everyone may not have that much of an inclination towards that math. But those of you who have, I would definitely recommend that please go through this appendix. And Hull has explained it pretty nicely. So that way, understanding the way or methodology to construct this implied distribution is comparatively easy. So let's say our model is there, and based on my traded options data, we were able to plot the implied distribution as well. We have two distributions, and we have this smile which we want to correlate. Now let's say that I want to somehow show the relation between these two. Let's say this is figure A and this is figure B. So we'll keep the nomenclature easy so that we can address them easily. Now, if you see, there is a thickness of tails here. So if you focus on figure B, and if you see the full line versus the dotted line, so focus maybe on this section, on this side of the section. So if you see the thickness of tails, that is different. So when I say thickness of tails is different, what exactly am I trying to explain? So what would thickness of tails tell me?
Deviation.
Okay.
Probability
Anything
of
more?
an adverse event.
Exactly. Very good. So both correct responses, but Ali's response was spot on. So thank you so much. So when you say you have a higher thickness of tail, or if you have fat tails, that means that there are higher chances of extreme events happening. That's right, isn't it? Because whenever I have, let's say, a longer tail, then naturally these extreme events are more, because I know that finally the area under the curve has to remain as 1. But whenever I have thicker or fat tails, then I have more number of probabilities which are locked into that fatter tail. And whenever that is the case, my chances of extreme movements are higher. So that's what to try to explain through fat tails. So as Ali has rightly said. Now, if you compare the tail widths for these two distributions, now you see that the tail for implied distribution is comparatively wider or thicker as compared to the tail for a log normal. Because if you see the dotted line is below this full line. So that means the extreme events which you expect for a implied distribution are comparatively higher as compared to the log normal distribution. And we know that implied distribution is something which has been derived based on the traded options data. That is, the traded options are trying to capture a risk which is more or which is actually more as compared to what a log normal distribution will understand. And because of that, we have a thick tail. And that means we can say that the implied volatilities which are trading in the market are comparatively higher. Now, why we say that? Because whenever the risk which is embedded in a certain option is higher, naturally you expect the volatility number for that option to go up as well, because volatility is going to explain a measure of risk for that option. And if you have an option position which is slightly more riskier, naturally you have a higher volatility. And once the volatility starts shooting up, the options get more expensive. So that way, these options will have a higher cost, or maybe the premium which you're paying for that options will be higher. Now, since the implied volatility number is expected to be higher as compared to the log normal one, that's what we see in this upper slope or this upward movement which we see in the smile. Because we have a thicker tail for implied distribution, we have a higher implied volatility as well. And that's why this upward curvature. Similarly, if I see the right hand side as well, now focus on the things to the right of K2. Now here also, if you see, now for FX, this is generally a scenario which you'll observe. Now again, this is a very ideal scenario. We have a perfect smile. But here as well, if you see the tails, the implied distribution has a thicker tail as compared to the log normal one. A thicker tail implies a higher probability of extreme events. That is, it implies a higher risk. The higher the risk, the higher is the expected volatility. And that's why you see an upward curvature on this side as well. So this is how we can try and correlate figures A with figures B. I'm sure there may be some other analysis as well, but this is something which is slightly easier to understand. How exactly implied gets derived? I have given you the reference, so I would request you guys to generally browse through them, because that way things will be easier. Because if you happen to join an options trading desk at a certain point in time, you'll already know this idea, because option traders will know these things because they have been doing these things in and out. But if you are maybe new to the bank or maybe new to the business, if you know these things at least from a theoretical perspective, then relating it with what happens actually, that becomes easy. Because wall smiles, etc., are important inputs which are used by option traders whenever they are to take a certain trading position. Now, again, one point to remember is it is not just the smile analysis which is going to play a role. Along with this, also the experience and expertise of the trader also gets used. Because finally, that is more important, I would say. Now, these are all mathematical constructs. They are also relevant and they are showing what is happening in the market. But interpreting these numbers and also looking at the broad market, that is something which comes through experience. So generally, if you happen to join an options trading desk, you'll not be given an entire options portfolio to immediately handle. Now, you'll be given a small portion of the portfolio and your actions will be reviewed by a senior trader, because senior trader has been around for a long time and they know how the market behaves. But at that time, if you are familiar with these theoretical constructs, then the things which the senior trader is trying to explain to you, that become easy. And that's why this analysis is important. If I take a step back, a few points which we have to go through. Now one thing which I have simplified for FX files. I think there is a question. Yeah, Ali, please go ahead.
Sir, could you go back to that same slide, please? I have a question
Yes.
on that smile itself.
Yes.
Sir, if you see over here, so generally for options, the closer the strike price is to the current price, maybe the volatility is going to be higher, right? But here it's a smile. So it implies that a higher strike price also commands a very high premium. So why is that?
Uh,
Like, shouldn't it be a downward facing curve generally?
so generally, the way to interpret your question would be, or maybe answer your question would be, what happens is OTM options or out of the money. These are comparatively cheaper. So that way, the demand for those options is higher because many people say that fine, these are cheaper, so our capital outlay is low. But if there are extreme movements which can happen, then we stand to make a large profit. So that way, maybe from that demand perspective, you see a higher curvature on either sides away from the ATM portion. So that could be one of the ways to answer your question.
But say usually premiums are highest when you are the closer you are to ATM, the higher your premiums are, right? So in this
Correct.
case, shouldn't the smile be inverted?
So the thing is, ATM options, they are very expensive. So that way, the number of people who would actually want to buy those things, or maybe the demand for those options could be comparatively. So yes, there will be demand, but if you compare it with maybe out of the money options, they will be comparatively lower because OTM options are cheaper to purchase. So because finally every trader would like to look from a P&L perspective. So they would say that if based on my analysis, I expect an extreme movement to happen, then I might as well purchase a OTM option, which is very cheap at the moment. And if my thing materializes, then yes, if that swing happens, then I stand to make a gain. So that is generally why we observe a certain upward-looking smile on either sides of the ATM. So either OTM call or OTM put.
So sir, in this case, this smile is for OTM products. So what about ITM in the money options?
So in the money options, yes, they are going to be very, very expensive. So for in the money, what happens is yes, the liquidity is very, very high, but the cost which one has to pay is also high as well. So that way, generally, if you look from a trading perspective, option traders will not really trade very heavily on the ITM bit because they also know the cost which it entails. So generally, something which is away from ATM is what generally the market will try to target because it's comparatively cheaper and it may make sense based on their analysis as well.
So I am still not clear on this part. Like in like in this like in this upper one, this upper chart, I'm not able to interpret the extremes. What do they represent?
So extremes basically are trying to explain the probabilities of extreme events materializing. And that is completely based on the implied distribution, which we are showing. So again, based on the thickness of the tails, which you had mentioned earlier. So when you have a thicker tail, which is the implied curve, then a
Mhm.
thicker tail implies that the chances or probability of extreme events is higher, something which your normal Black-Scholes model is unable to understand because your Black-Scholes is dependent on log normality. It doesn't use implied. So as compared to your modeling, what is actually happening in the market is different because you have the implied data which is available, and that implied data is pointing to a chance or a probability that the chances of extreme events on the tails is comparatively higher as to what your theoretical model is saying. And because of that, you're trying to relate this thicker tail with the upward slope.
Okay, sir. I guess I'll just read more on this and then get back to
Sure,
you with
definitely. You
questions.
can go through it more. We can definitely discuss that offline as well. Not a problem. Now, I've done one simplifying assumption here. So now FX wall smile, this is not, now this is like a ready smile, which we can use. But for FX, we don't get the data this way. But generally, what you get the data is in terms of deltas. So again, delta is a form of option Greek. And the FX data is always quoted in, or FX option data is quoted in terms of deltas, what the value of the delta of your option is. And that delta has to be converted into a strike. So again, there is a standard calculation which helps you convert your deltas into strikes. So that way, such a ready structure is not available. You need to do a few calculations to move from IV to strike. So I think there is one good paper by Wistup. So Professor Wistup's paper on this conversion. So I'll also look up if I have this paper. Uh, again, the approach is slightly tedious. So maybe implementing these things hands-on could be a bit of challenge. But yes, if you do have the time, you can definitely explore that. What you can do is you can fetch options delta. So I guess you guys have a Bloomberg terminal in your institute. So maybe you can get a certain FX options data and then try to construct a wall smile based on this. So let me look up Vistup's paper. I don't recollect the exact name, but if you simply try to maybe do something like FX wall smiles plus Vistup, that is something which will take you to that paper because it's available in the public domain and something which will help you get more clarity. So Uwe Vistup is actually an authority when it comes to FX options or FX in general. So he has multiple research papers, and this is one of his papers, which is excellent, by the way. So I'll also look up. I had seen this a few years back. If I do get a hold of it, I'll email it to you guys. If not, I request you guys to do a Google search, which will give you this transition. Because again, these are some things which are not expected when you're a fresher to the industry. But over the years, as you gain more experience, and let's say you're trying to gun for a certain senior position, then at that time, these are the questions which can come up on interviews. So let's say you're trying to join as maybe a VP in a certain maybe certain investment bank. So let's say one of these JPMs or CS who have their opened up their shops here. So at that time, maybe at that level, you may be asked that, let's say I have this FX watch data which is available. So can you tell us an approach as to how we can convert that into, so we have the option deltas. So can we convert that into strikes because we want to construct a wall smile? So can you help us with that approach? So at that time, if you are familiar with these things, then addressing those questions becomes comparatively easy. So, but if you generally start brushing up these things now, it will be easier for you later on as well. And these are something which is very, very relevant. So I would suggest that do look up Professor Vistup's paper. If it's not available or if it's not easily available, I'll also quickly see in my repository. And if I get a hold of it, I'll immediately send it to you guys. Pictorial representation is done. Implied.
So what is his full name?
Professor Uwe Vistup. So he's a German professor. And I think his firm's name is, the exact name is, I think, Math Finance or something. Yeah. But if you simply look up Vistup, you'll get a lot of links because he's a very, very popular guy when it comes to FX. Rather, he's an authority in FX. He has a couple of books as well. So something which you can generally browse through. So that way, I mean, every asset class has someone who is an authority there. So for FX, it's Vistup. Now for fixed income, it's Frank Fabozzi. So Fabozzi is excellent for fixed income. So I'm sure in your library, you'll have a handbook on fixed income securities by Frank Fabozzi. It's a very large book. You actually don't have to go through the entire thing, but a few things you can generally browse through. Vistup is for FX. Now for anything specific on interest rates, so Hull is a decent start, but Hull is not all inclusive. But a slightly complex one can be Brigo and Mercurio. So I'm giving you these references because these are something which industry participants frequently use. Of course, now at the moment, a few things may be challenging because you guys are new to these concepts, but stick to them. So over a period of time, as you read through these references, it will bring more clarity. For FX, I've already told you Vistup. For equities, not very sure about equities. But one decent place to start all of these things, because Brigo, Mercurio, etc., maybe even certain concepts in Professor Vistup's book are maybe difficult to pick up. But a good start is John Hull. Now, John Hull has become more like a textbook, to be honest. I know it's a reference book, but people use it more as a textbook now. So John Hull and Wilmot's book on quant finance. These are two decent references to start with. Now, those of you who want more in-depth analysis into the math finance side of things, Stephen Sherway. So Stephen Sherway has a 2-volume book, a huge book. But those of you who have the time and energy to go through that, you can browse through. So there is something on discrete time and something on continuous time systems. A very extensive book and a very heavy math treatment to it. So if you have that inclination, then Stephen Sherway is a good reference. So I would say if you're in your library, if you have these references, you can generally borrow them, go through them, and I'm sure there'll be a lot of things which you'll get online. So maybe excerpts of certain books will also be available. So that is something which you can keep a track of. So have you used any of these references? So maybe you might have used Fabosi in the past, so possibly as a part of your SAPM. So did you have something on security analysis and portfolio management or something like that, or capital markets? So at that
So
time,
we've
maybe,
referred Hull. Hull we've referred extensively.
okay,
And we'd
okay.
also referred an Indian author.
So I think it will be, I think, Shankarshan Basu, is it?
I think it was Pandian.
Okay, okay,
Parvati. Yeah, Pandian.
okay.
Yes,
Because
sir. Punitha Varti Pandian.
okay, I see. Yeah, no problem. I mean, Hull is a good start, but I would say that maybe spend some time on Wilmot as well, because the concepts which you have discussed, you will find those related to the things which are there in Wilmot's book. So, request you to go through that as well. Yeah. Now, a couple of reasons as to why we see wall smiles in FX options. So, firstly, volatility is not constant, and prices exhibit jumps very frequently. Now, these are the two assumptions which we don't use as a part of our normal Black-Scholes modeling. Now, if you see the Black-Scholes framework, we are using a constant wall. Also, at the same time, we are not assuming any kind of jump conditions which are happening in asset prices. Now, then a natural question can be, if a Black-Scholes model is having so many drawbacks, then why do we have to use them? Can't we simply junk the Black-Scholes model and do something better? So, a very valid question. But the thing is, we generally do not junk things which have been around for a very long time and something which are time tested. Now, a Black-Scholes, I won't say a model as such, but Black-Scholes framework. Now, the Black-Scholes framework has been around for a very long time, and that is something which the market has adopted, and it is consistent with what generally is observed in the market, or it's largely consistent, I would say. So, in the market, what we do is whenever something has been time tested for a long time, we do not junk that. We tweak that and then we apply certain enhancements on top of it. So one enhancement which we apply on top of Black-Scholes is we use the basic framework as it is, and we try to use the impact of this wall smiles. Now, when we say impact of wall smiles, I'm trying to take a volatility which is non-constant in nature. So I continue to use the exact same Black-Scholes framework which I've studied, but rather than a constant wall assumption, I can use a wall number which is more flexible, or which is a more realistic picture of what is happening in the market, and a realistic picture is what the wall smile is giving us. So that way we use the basic model and then apply something on top of it. So this is something which you'll commonly observe. Now, something which has been time tested, you're not going to junk that. You'll stick to that. You'll use it and apply enhancements wherever required, because reinventing the wheel takes a lot of time. So a market also doesn't have that much amount of time, and something which they believe has performed well over the years, they are not going to throw it away. So something similar which you have to use on your projects as well, something which has been time tested, don't try to remove that. Stick to that, because there is a certain reason as to why people are using it. And wherever you require enhancements, small tweak can always be done. So one tweak is a non-constant wall. Similarly, other enhancement can be a non-constant interest rate. So if you recollect, one of the assumptions of Black-Scholes model was a flat interest rate or was a constant interest rate. So you could apply maybe a time-dependent interest rate. So based on your time to maturity for the option, you can choose on what is the appropriate interest rate to use. So that way you get a more realistic assumption of interest rates used as well. So although there are drawbacks to Black-Scholes framework, the market appreciates that, but the market knows that something which has been stable and which has performed well over the years, you still use them and then you apply enhancements wherever required. So that's where the smile adjustment gets used in your Black-Scholes assumption. So in a nutshell, you're trying to move away from your constant wall into something which is more market driven or something which is coming from a smile. And this is also, now this small enhancement is also what we call as a Vanna Volga model. A Vanna and Volga. So a Vanna Volga is nothing but your normal Black-Scholes plus the smile adjustment. So again, a very useful model whenever we are to price maybe first order exotic, something like a barrier option. Because for barriers, etc., we generally try to avoid using Black-Scholes because the pricing which you get with normal Black-Scholes model is not good enough. So you have two choices. Either go the Vanna Volga way, which is simply your Black-Scholes plus the smile adjustment, or maybe go the complex way. So something like a stochastic volatility or something like a Sabre model, SABR. Now, stochastic volatility takes a lot of effort. Now, it requires both efforts from the technical study as well as building the model. But Vanna Volga is something which is comparatively easy. So if you ask from a trader's perspective, they'll always prefer a Vanna Volga because that is something which they can also quickly compute. Because from a trading perspective, they may have to make a quick decision based on what the data is, and they may have a certain opportunity at hand. So at that time, Vanna Volga happens to be a popular approach. So, so if you guys have access to Bloomberg in your institute, then you can check out OVML. So OVML is the options pricing property or pricing functionality inside Bloomberg. So inside OVML, if you select FX options, it will show you a drop down for Vanna Volga. So maybe you can see the impact of the price which happens after this adjustment. If you don't have Bloomberg, then as I had mentioned earlier, you can request your institute to maybe have a demo session with Bloomberg. Now, Bloomberg always does that for academic purposes. So maybe you can have an hour-long session. So at that time, maybe you can ask the Bloomberg representative to take you through OVML, and that way you can see the impact of Vanna Volga. So maybe you can request the representative to price an option using Black-Scholes and Vanna Volga and see the impact. So that could be a way to understand things which happen in practice as well. Equities, my guess. Now, for equities, this is like a general smile which you see. Now, there is a reason why there is a slight change in shape. Now, again, this is a very, very idealized scenario which I've shown. Now, this may not be the case all the time. Now, for equities, why we see this downward sloping? Now, again, the reasoning is very, very similar to what we have done for FX. So based on the thickness of the tail for implied distributions, we have this smile which is being plotted. So on the left-hand side, where I have a thicker tail, I have an upward sloping curve. Whereas on the right-hand side, I have a thinner tail. So I have a downward sloping curve. So one way to interpret this is it has to do something with the leverage of the company. So generally what the market says is as the leverage of the company increases, then it's putting more pressure on company finances. So as the financial leverage increases, the riskiness of the company increases. So that way you see a slightly upward sloping smile. Whereas if your company's leverage drops, that means your company is becoming more safer or it's less riskier from the investor's perspective. You may see a downward sloping smile. So that's how we generally try to interpret equity wall smile in a very simple way. There can be other technical reasons, but this is the most easiest non-technical reason. So have you guys discussed leverages in the past? So was this discussed as a part of your corporate finance class?
Yes, sir, it was discussed.
Okay, correct. So when we say leverage or financial leverage, we know it's like a fixed interest cost for the company. So leverages, yes, they have a certain pluses and minuses with it, because we know that as the company levers itself, that is, as its fixed interest cost increases, it has a chance of enhancing portfolio valuation for investors, but the riskiness of the company also increases. So because we know that if a company is issuing multiple bonds, then their fixed cost is going to go up because they know that those bonds have to be serviced no matter what. And that is something which we try to understand through financial leveraging. And that is the same idea of leveraging which we try to apply to the equity parallels, because as the leveraging increases, the company becomes riskier. And as the leverage drops, the company gets safer. So that's a very crude way of interpreting this. There can be other finer points around this, but that is something which we'll not cover right now, but we'll cover something which is non-technical, something like the leveraging bit. Okay, and again, for this, again, there's a separate chapter on wall smiles. So anything in addition to our discussion, I request you to go through that chapter. And it's a very interesting chapter, I would say. So whenever you do get an opportunity, generally go through the wall smiles bit. It is very, very interesting. So we have time, so it's 10:30. So let's discuss something on CDS, or what we call as a credit default swap. Let me just open up another discussion slide. Yeah, I just finding that I've saved it somewhere. So in the meantime, I request you guys to generally start brushing up on your Python bits as well. So I emailed on Saturday. So your next assignment will be based on Python. So so maybe start brushing up those things, and maybe probably maybe 10 or 15 days before before the exam, I'll let you know what the model is. Now, I would generally prefer this to be like a group assignment. So I'll just inform Shrikant sir accordingly, and I'll let you guys know. Anyways, I'll be putting a detailed email about what exactly is to be done. All right. Let's start the presentation on CDS. I drawn one block diagram earlier, so I've just taken that slide directly. Now, when we have a CDS or a credit default swap, there are two parties to this transaction. So we have a buyer of the CDS and we have a seller of the CDS. So now CDS has become kind of notorious in 2007, 2008 during the financial meltdown. And the reason why CDS became notorious is because the volume or the kind of MBS or other securitized transactions which were trading at that time were too high in number. Now, we know that MBS products or mortgage-backed securities, these are all risky products. Now, I won't say that every MBS is subprime in nature. So is everyone familiar with the connotation of prime and subprime borrowers?
Yes, sir.
Okay. So of course, now in 2008, not every mortgage was subprime in nature. It doesn't work that way. But yes, a considerable portion of the mortgages was subprime. So when I say subprime, that is those are the borrowers who have a very weak credit history. So in India as well, we have a reference for credit history, which we call it the CIBIL score. So you can get to know your CIBIL score. So generally based on how exactly you have repaid any loans which you might have taken, or maybe have you repaid all of your credit card bills, etc. Everything reflects in your CIBIL score. And that CIBIL score happens to be an important metric which helps banks determine whether a certain individual is really credit worthy or they have a very sketchy credit history. So something similar gets applied in the US or in other markets as well, whereby firstly banks will do a credit analysis of borrowers. Now, in 2007 or up to the build-up for 2000 or 2008, what happened was the volume of subprime lending increased manifold because the housing market was booming and everyone was very, very optimistic. Unfortunately, it was a bubble which was being created because even the banks knew that they were simply lending it to subprime borrowers. And many a times you had a very popular product which was launched at that time, which you call as an ARM or an adjustable rate mortgage. So an adjustable rate mortgage has something which we call as a teaser rate. So let's say my mortgage is for 15 years. then a teaser rate implies that for the first 2 years, I have a very, very low interest rate. So it could be below market as well. So that way, subprime borrowers are immensely happy because servicing that kind of a loan is easy. But the moment the 2 years gets completed, the rate simply resets to the market, or there's a sudden jump in interest rates. So at that time, making repayments by subprime become difficult because they simply cannot service such a high interest rate. So generally at that time, you observe that multiple subprime borrowers started defaulting on their commitments. So I mean, the ARM mortgages were immensely popular during that build-up, but post 2002 to maybe post 2008, the volume of ARM loans has come down considerably. So now the banks are not really offering too many ARMs or adjustable rate mortgages. But again, that was precisely the reason as to why there was so much of dependence on the CDS market, because banks required some way of managing the credit risk which they were adding on their books. So there were two things. Firstly, there was a lot of securitization which was happening. So you had banks which were issuing MBS type of products to all the market participants, and they were selling these products left, right, and center. And everyone, right from corporates to large investors to other banks, everyone was holding a piece of securitized products. And whenever they are holding such a product on their books, they would require some way to manage the risk, isn't it? Because not everyone will keep a naked position. Now, many people may say that, fine, we have taken a risky position, we want something to safeguard that position. So to safeguard the position, you require a certain product, and that product happens to be at that time, CDS was something which was very frequently used. So the idea of CDS is it will function somewhat like an insurance contract or like an insurance transaction, and the CDS is going to protect you against any kind of potential credit defaults which can happen. So let's say I could have a certain loan. Or maybe a certain bond which I have purchased. So maybe a bond ABC, or a security of ABC Corporation. And let's say this is a securitized product. Imagine it's a risky product. So as a part of this transaction, I'm going to have this triangle which I'm looking at. So I have a protection seller, I have a protection buyer, and I have this underlying which I'm looking at. Now that underlying could be some investment which you have taken in or some asset which you're holding. Now, that way, you may not have direct relation with ABC, not at all. Now, you may be a plain investor and you have simply purchased a securitized product which is of ABC Corporation. So that is your relation to ABC Corporation. That's it. You're an investor or a trader in that quantity or that asset. Now, you as a trader might want to hedge your position because you know that that's a risky product. So you want some way to protect yourself. So at that time, you use a CDS or a credit default swap. So imagine that I am holding an exposure to this particular bond. So I become a protection buyer because it is me who wants to purchase protection on this. That is, if something goes wrong with ABC, then I require something to protect me from that default or any other action which is going to impact me adversely. So at that time, I'm going to approach a counterparty, so a protection seller in this case, and I'm going to tell them that I have a certain underlying and for which I require a protection. So can we enter into a CDS transaction whereby you purchase the credit risk from me? Now, of course, you're going to charge me a fee for that. So I'm going to pay you a certain premium. So you can imagine this premium is very similar to the options premium. Behavior is slightly different, but the idea is similar. That is, I am trying to move my risk onto someone else. Now, someone else will not take the risk just like that, isn't it? They are going to charge me for that. So a buyer will be expected to make a premium payment to the seller. So the seller, once they receive the premium payment, and this is more of a periodic payment. So I'll show you the cash flows as well. So I make a payment to the seller, and that way my credit risk, that is my headache of something going wrong with ABC, gets transferred onto the seller. So here, if you see, I'm not eliminating the risk. I'm simply transferring the risk. Something which was my headache, that monkey on my back has been transferred onto the seller. But that risk still exists in the system. And that is something which many market participants might have got wrong. So many of them thought that you have a CDS market which is very liquid, so our risk is completely taken care of. But again, these CDS sellers are also a part of the broader market system. and many of these CDS sellers are they may be market makers or they may be active traders in the CDS space, and there can be a contagion effect. So if a group of sellers defaults, then that can result in other sellers defaulting as well, and that was precisely which happened in 2008. So once the housing market collapsed, there was so many defaults which started happening that it went through the entire system. So that's where we saw the complete meltdown happening. But again, post that, the CDS market has also recovered again, and people have started using CDS products. Now, to give you an idea of the cash flows which happen on the CDS, so we have, let's say I have a 1 year CDS, and let's say the frequency has been set to quarterly. So Q1, Q2, Q3, and Q4. So you have the buyer and you have the seller. So let's say the premium which we decide is, let's say, P. Now, to understand this cash flows, we are going to see two scenarios. One is no default. And second is a default happening sometime in between. So this will help us understand the way in which these cash flows work. Now, in a no default scenario, what happens is the buyer is going to pay a periodic premium to the seller. That is, payment P is going to be paid at the end of each, or at the start of each quarter, start of each new quarter to the seller. So no default, that means the buyer simply makes a premium payment and the seller has to do nothing. So they simply receive the premium and they're happy because no credit event has occurred. So there is something which we call as a credit event. Now, what is the credit event? We'll see in a bit. I'll tell you a few list of popular credit events. But imagine for now that credit event is something like a default, or it's mimicking a default. So we are assuming a no default scenario, which is scenario 1. So in this case, since there is no default, the premium payments are being made by buyer to the seller. So the seller is immensely happy, no action to be done. Now imagine a second scenario whereby a default occurs, and let's say the default occurs at after period 2. So the first 2 periods were live. So this was no default. But in Q3, the default happened. So in this case, for the first 2 quarters, the buyer will definitely pay the premium because no default has occurred and the buyer is still holding the protection. So premium payments P will be made at Q1 and Q2 as per the schedule. Now at Q3, a default event has occurred. So that means at Q3, now here the scenario is going to change. The premium payment doesn't happen for Q3 and Q4 because at Q3, a default has occurred, and at that time, the seller is supposed to make good the loss which the buyer has been exposed to, because this is like a credit loss, isn't it? Because ABC Corporation has gone in for a credit default. So if it's a credit default, then the seller is expected to make a payout to the buyer, because that's why precisely the buyer has purchased the CDS, right? The buyer is trying to mitigate the credit risk. So if a default happens in Q3, all of the future premium payments are going to cease to exist. That is, premium payments at Q3 and Q4 will not happen, but the seller will make one short payment to the buyer in order to make good the loss, and the contract will cease to exist. So whenever the default occurs, the seller makes a payment to the buyer. The buyer is not going to make any remaining premium payments, and at that time, the contract will cease to exist. So this is the basic mechanism for a CDS transaction. So any questions on this mechanism?
Sir, how are the CDS priced?
So yes, I mean, pricing is slightly complicated. We'll not be getting into the pricing bits, but again, the way in which you price things is you require two ideas for pricing a CDS. You require, naturally, the bootstrap curve is required because you require it for interest rates and discount factors, etc. And you require what you call as a survival probability. Survival probability, or I would say the flip side of this coin is the probability of default. Now, there is a certain approach or a certain way in which survival probabilities can be calculated. So there is a bootstrapping algorithm. So again, the nomenclature bootstrapping is similar. Now, we had used bootstrapping for interest rates. Now, a similar idea of bootstrapping gets used for CDS spreads as well, because we know that a CDS market is very, very liquid. So let's say I'm looking at USD CDS on maybe JP Morgan, that it has a very liquid CDS market. So I will have CDSs at different tenors which are being quoted. So I could have, so this is my CDS spread data. And I could have the spreads for 1, 2, 3, 4, and 5 years. And I would have some spread numbers which the market is quoting. So I have an algorithm which converts these spreads into survival probabilities. And these survival probabilities are something which will get used in this calculation. So actually a few components which if I had to list them, the notional, yes, then I'm going to require the interest rates or the bootstrap curve. I'm going to require the frequency. I'm going to require the probability of default or survival probability. Yeah. So I'm going to require these quantities in order to price two legs. So the pricing will be similar in idea to a swap. So just like for a swap, we have two legs which we are pricing, a fixed and a floating leg. So here as well, we are going to calculate the PVs for the buyer and PVs for the seller. And once those PVs are available, we simply take a difference in order to calculate MTM. So in this slide, I don't think I have that calculation, but what I can do is subsequently, when I share the slides, I will add one more slide, which will give you the way in which cash flows are calculated, so that you have an idea as to how survival probabilities and these interest rates are used in the calculation. So you'll at least have a rough idea as to how do you calculate the PVs of individual cash flows and how do you price a CDS. So that is something which I'll include in the slide which I emailed across. But this algorithm is something which is pretty standard. So if you go to my blog page as well, I think last year I had written one article around bootstrapping of CDS spreads. So something which you can check out. So that was one approach for deriving the survival probabilities. So I had taken a hypothetical data of CDS spreads and I had bootstrapped them in order to calculate survival PD. So maybe you can generally go through that article as well. That will give you additional insights. And as promised, I will add this slide on cash flows and I'll email it to you guys. So does that sound okay? Okay. Now, I just made a mention, but I'll try to put some mathematical numbers around it so that, or maybe at least the simple mathematical formula, so that it will help you interpret these two definitions. This is precisely what we had discussed. Now, what is a credit event has been given in the next slide. Now, after the occurrence of a default or a credit event, as we call it, generally the payment which is made is par value minus the recovery rate. And the standard recovery rates which we use in the market is based on the seniority of the bonds or seniority of the debt which you are looking at. Now, we know that there is a certain idea of seniority. So as maybe as a part of your corporate finance structure or corporate finance syllabus, you might have been introduced to the idea of seniority of certain assets. So if I'm a debt holder and if someone else is or maybe let's say there are two individuals, X and Y. X is a debt holder and Y is an equity holder. And let's say our subject company is ABC. Now, if ABC goes in for liquidation, then which of these has a higher seniority? So will X get priority or will Y get priority if ABC has to go in for liquidation tomorrow?
That will get priority, sir.
Correct. Very good. So because the thing is, debt holders always command a higher seniority. So in case of liquidation, they are the ones who will be serviced first, and whatever remains after that will be passed on to equity holders. So this is also what you call as, or we try to understand through the idea of recovery rate. Now, recovery rate is generally assumed to be 40% for bonds and 60% for bank loans. So this is like a I won't exactly say a benchmark, but something which the market uses very, very often. Because the thing is, whenever certain entity has defaulted, that does not mean that the bonds also which were issued by them have a zero value. It doesn't happen that way. There will be some value associated, maybe a certain liquidation value, which we try to capture through the recovery rate. So that's why we keep it as 40% for bonds and 60% for bank loans. And based on that, we decide the payout which the seller has to make to the buyer. Now, a few credit events which are listed here. Now, one is a partial or a complete default. So let's say I'm talking of a ABC Corporation bond. Now, a bond may make, let's say, certain defaults on interest payments which were due from them. So that is what you call as a partial default. So maybe ABC Corporation has some temporary business pressure, because of which they are unable to service certain interest coupons, but otherwise they are able to service it later. So that's what we call as a partial default. Now, if ABC Corporation says that and we don't have money, we can't service anything, then we call it as a complete default. Then they may file for bankruptcy. So something which Lehman did as well. I mean, if you simply can't do anything, and if your assets are junk, you can basically file for bankruptcy. You can file for bankruptcy protection, and that is also called as a credit event. So when I say credit event, all of these are considered as a tantamount to default. So if any of these are going to occur, we say that a default has happened and the seller has to immediately make a payment to the buyer. So that clause immediately gets triggered. Next is credit downgrade. So the condition in the CDS term sheet may say that ABC Corporation is currently rated AA. Now, if the AA rating falls to, let's say, BBB, it's a default and you're expected to make us a payment. Now, ideally, it's not a default, but as per the definition of the CDS terms, this is considered as a credit event. So it will trigger a payment from the seller to the buyer. Then any kind of restructuring. So if a company goes in for a corporate debt restructuring or any kind of restructuring of their capital structure, then again, that can trigger a CDS event. Then if the price of the underlying falls below a threshold, so you may have a certain price level. If the price level of the ABC Corporation bond falls below that, we say a default has happened and the buyer is going to demand a payment. Then unwillingness of the bond issuer to make periodic payments. So the bond issuer says, I mean, we are not going to make the payment. The reason could be anything. It's simply a default. Or there could be a certain provision from a legal point of view, which is making payments impossible. So maybe there is a moratorium period which has been set by the regulator. So at that time, it may so happen that, I mean, the issuer cannot make payment because the regulator has said so. But again, that can be considered as a credit event. So generally, whenever such cases are there, I mean, idea of moratorium which has been imposed by a regulator, etc., generally CDS terms also get tweaked at times, because the market knows that something which the regulator has decided is something which has to be abided by everyone. So maybe if both parties agree, they can tweak the terms for such a moratorium case. Then on or payment at default, generally through a dealer poll, we try to calculate the difference between the par value of the asset and the post-default price. So how much is the asset worth? So that can help us figure out how much is the payment. Or other could be the par price plus a certain recovery factor. Now, generally, recovery factor is something which we pre-decide. So at the time of signing the CDS contract, this is something which gets pre-decided. Or the seller pays the par to the buyer. Now, this is also what you call, now the last case, this case C, is what you call as a physical delivery or physical settlement. Now, why physical settlement? Because the buyer is going to deliver the underlying asset. So the seller will simply make a par payment to the buyer, and the buyer takes the asset, the defaulted asset, and gives it to the seller. So that's what we call as a physical delivery. But one point to remember is through a CDS transaction, you are able to transfer the credit risk, which is there in your books. So again, if you're purchasing a CDS, then you as a bank will be expected to allocate certain capital for CDS as well, because it's a risky product. So as a part of your Basel capital guidelines, you're expected to have a certain certain capital provisioning for CDS. Similarly, you'll have other things like exposure monitoring, which will happen for a CDS. In addition, you will also require a CVA adjustment, something which we have discussed earlier, credit value adjustment. So these are the things which will always be there when you start trading the CDS. Now, in India, we don't have a serious market, unfortunately, because our bond market itself is in a pretty nascent stage. But there are efforts on from the regulator in order to improve liquidity of the bond markets, and hopefully we'll have a well-functioning bond market in the coming years. But at the moment, we don't have a serious market. But Indian banks, whoever wish to transact in the CDS space, they generally do it through Gift City. So as a part of Gift City, they may be having CDSs which are there on the books. So if you happen to join a bank and if you are part of their Gift City desk, then you'll get to see a certain structured or exotic products. Now, this is not really an exotic product. It has become pretty standardized over the years. So post 2008, one more thing which happened was a kind of standardization which had come in to the CDS market. Now, a standardization had come in because the regulator and also the market participants realized that this is a product which is frequently used by market participants. And there is some way, or there should be some way in which things can be streamlined. So that was when there was an idea of a standardized CDS contract which was designed. So that way, there are 4 settlement dates in a year, which is defined for every CDS transaction. And any market participant who wishes to trade CDS now will do it on this standardized CDS framework. So this is technically also what we call as the Big Bang reform, which had come in post 2008. But nowadays, whatever CDSs you see in the market are standardized in nature, and that is after this reforms framework. So the cash flows bit, as I promised, I will be putting it in the slide and emailing it across. But this is one of the ways in which CDS or maybe credit risk gets transferred. Other things are, it could be a credit link note, or maybe it could be a first to default put, etc. So that way there are multiple options which are available. We'll not get into each of them in detail because, and firstly, I mean, covering those things is slightly challenging because they are slightly complicated to understand. But CDS is something which is comparatively easy. So I'll share across these slides as well. So do we have time? It's 11:05. All right. So just about 10 minutes more. All right. So we have yeah, Ali, please go ahead.
So just a question on the CDS itself. So
Mhm.
why not opt for buying the asset itself? Why only buy the risk associated with the default and all that? Why complicate things unnecessarily?
Okay, so if I understand your question, it's saying that why don't I directly purchase the bond and so was that a question? I mean, do I just purchase ABC
Yes,
Corporation
sir,
bond
exactly.
and so the thing
Exactly, sir.
is,
Instead of exchanging CDSs, I can just buy these bonds of different companies and diversify my risk by directly having ownership of the asset. Why enter into a
uh,
derivative contract for that?
correct. So one point or one main point to answer your question is capital adequacy. If I directly start purchasing bonds of a certain company, that is going to start attracting a large amount of capital charge because we know that all of these are non-SLR securities. So they are going to firstly lock in a lot of capital for me, which may not be feasible. Now, honestly, I'm just doing this for trading purposes. I do not intend to hold on to this bond. So firstly, capital adequacy is one. Next is they don't really fit in with my long-term investment strategies because I don't intend to hold them till maturity. I just want to trade them. And third is derivatives attract comparatively lower capital as compared to a direct investment in bonds. And that way, from a trading perspective, it is much liquid for me to trade a CDS rather than trade a certain bond. Now, naturally, we are talking of a certain market where CDS is very, very liquid. So that way, I can still take a trading position, and I don't really have to worry much about the underlying bond. So I think these could be a few reasons as to why someone might prefer a CDS as compared to a bond to get an exposure.
But sir, aren't they taking up excessive risk also on their portfolios? I mean, they're saving on the capital, but the risk is crazy, right?
Naturally, I mean, this is a risky investment because especially if I talk of CDSs, then yes. So now there are two ways to look at it. Now, one can be a genuine hedging requirement, other is speculative trading. So if it is genuine hedging requirement, then I may be really concerned about a certain bond which I may have an exposure to, and I'm really worried that if something goes wrong, then I can purchase, then I have a CDS. So if it's a genuine requirement and if I have the bond on my books already, then I will definitely purchase a CDS so that these two things will offset each other. So if the bond defaults, my CDS will give me a payout. So that way, if it's a real requirement or if it's a genuine requirement for me, I can use a CDS. If it's just trading, then I know that I'm taking risk, and I'm taking risk with the idea that there is a potential to generate profit. So that way my organization's policy is permitting me to take the risk. So I will like to take that additional risk uh, with the idea that a potential profit could be earned. So that's from a complete speculative or trading perspective. So I would look at it these two ways. One is genuine hedging, and second is plain trading or just trying to make profits from your trading activities.
Okay, sir, one last question.
Yeah.
Is there any regulatory limit on the amount of risk that these banks can take on their, you know, onto their portfolios?
Correct. Yes. So that limit will come through your risk policies. So we have discussed a few risk policies which are used by banks. So as a part of risk policy, a threshold will be defined. So your traders will be expected to stay within that threshold. So that will define the risk.
No, sir, not the risk policy for the bank, but generally, because my understanding is 2008 was because the banks were excessively linked to each other. That is why I think that is why the crisis got multiplied multiple in a way. So,
Correct.
post that, has there been any um, limits on the amount of,
Um,
government set limits?
Correct. Not really limits as such, but a few additional checks and balances have been introduced post the 2008 debacle. So the first check and balance is the regulator is pushing for most transactions to be moved onto a CCP. So regulators or even global standard setting organizations are of the view that the more role of CCPs we have, the better it would be from managing the overall systemic risk. So that was one reform. Other things is banks have also got more careful. So maybe when they're transacting in riskier products, they may ask for more collateral posting as well. So I think these two are the two main steps which have been done post 2008. But as a limit on the maximum trading which happens within banks, I don't think that limit has been set as such.
Okay, sure. Thank you so much.
Okay. So our last bit on Greeks, that is something which, as I mentioned, I'll send you a small note on that, so you'll be able to understand. At least we'll cover the basic Greeks. So I'll give you a description of each of those Greeks and how exactly they behave, maybe vis-a-vis with passage of time or with the strike price, etc., so that you have an idea of those things. I'll give a reference as well in the end as to the things which can be read on the Greeks part. So yes, I mean, we have majorly covered most of the things which we were set out to cover as a part of our discussion. Barring the Greeks, I think we have covered almost everything, and we managed to squeeze in some bit of hands-on exercises as well. I would have liked to do some more hands-on, but again, we only have a limited time. But my request will be that do continue with your hands-on exercises. So the things which you have studied as a part of our course or anywhere else, try to do as much of hands-on as possible, because that will give you more confidence to things. Because yes, knowing theory is important, but if you can convert that theory into something which is in a workable model uh, condition, then that will give you additional clarity and confidence as well. So not just now, but even at a later point in time, that will come very, very handy. And the things which we have covered in this course, I've tried to keep it very, very close to the things which we frequently require on projects in industries as well. So hopefully these things will come useful. And of course, I mean, you have my email address because I've emailed you. You have my personal. So maybe going ahead, also, if you have any questions, please feel free to drop me an email on my personal address. I will just write it in the chat. So that way, and generally I'm very prompt at responding. So maybe in 1 or 2 days, I'll let you know my views as well. So not just now, but even later on, if you require to discuss anything or feel someplace where I'll be helpful, then feel free to reach out. I'll be happy to help you guys. But it was great interacting with all of you. So thank you so much, and thanks for being interactive. It was really good. Otherwise, monologue gets boring. So thanks for keeping it participative. I really appreciate it. And we could not meet in person, but so till when are you guys in the institute? So when does your institute close for this semester?
So I think our last class should be in June and our exams will be in July.
Okay, okay. Because there is a chance that I will be visiting Pune, or rather, it's certain I'm visiting Pune around end of May. So maybe one of the days we could generally catch up for at your institute. Possibly we could just have a cup of tea or coffee together, and at least we could meet in person then. So I'll let you know my schedule. I anyways have your email ID, so that group email ID is there. So once my trip gets finalized, I'll definitely try to catch up. So those of you who are in Pune, we can definitely have meet up at least. I mean, we can meet informally. I mean, we have covered our lecture content anyway, but it will be good to catch up with all of you, and we'll anyways be in touch subsequently. So let me take the attendance for one last time, and we'll be done. So are you guys happy in general?